computer. Bow. So we're live and we're recording, and then I'm gonna go ahead and share my screen. Let's see, desktop. Bow. You guys just let me know if you can see it.
Yes, sir.
Yes.
Move this here. Bow. Move this over.
Can you do a full screen?
Of course. Yep.
Yo. Uh-huh.
All right, how are we looking?
Cash
Perfect.
it out.
Cool. So as most of y'all already know, I go by Curtis G, and the kind of campaign that I got going that I'm really getting on is Road to 1 Million. And so for the most part, what I focus on my social media profile is dividend income. But really, it's not just dividend income, it's passive income and really get into the $1 million threshold. And the reason why I think about that is because for some reason, internally, I feel that within the next 3 years, and that's a real aggressive time frame, all the way out to the next 10 years, that a lot of us are going to need to have $1 million tied to our name. Whether you've got $1 million stock portfolio, or you've got $1 million worth of real estate, or something of that nature, just because of the way the global economy is going and inflation and things of that nature. So having some type of $1 million portfolio, even if it's a combination of the two, is going to be like a threshold or a benchmark that we want to set for ourselves minimum going into the future. But specifically tonight, we're just going to focus on the dividends. As you guys see, that's kind of my thing. And that's what I'm always like sharing with the family and everything like that. So most importantly, though, steps that I believe are important before getting into dividend income or passive income investing are these right here. And I know a lot of this is what we know, but I think it was very good to show it visibly. And one thing I will say before I really dig in and we get started on this road, family, is I'm extremely transparent. So all of the screenshots that you guys are going to see, these are my screenshots. All of the things that you're going to see throughout this presentation are accurate as of today or the trading close on Friday. So most importantly, before getting into passive or income investing or dividend income investing, is to get life insurance. And I put that in gold because it's going to come into play in several ways throughout your journey. But the most important thing is that's the easy ticket for our loved ones, if and when something happens to us, to get them financially squared away. And I feel like this group of people, us, I refer to us to other people as Black Wall Street. That's what I call us, Black Wall Street. We're all up on game about that. We're knowledgeable. That's not something that's new to us or something that we've already, haven't thought about. But I just wanted to reiterate, get life insurance as like the number one step. Don't start building a passive income portfolio and putting all this money over there when you can take a few dollars each month and get you life insurance. And if something happens, you've got your family members already at the end of that road to $1 million.
Right.
Of course, the next thing is to pay off bad debt, credit cards, card note, things like that. And this is why I put these screenshots here. These are live, accurate. You see, they're very recent. A lot of people were like, should I pay off my debt? Should I pay off the credit card, or should I start doing my dividend portfolio? And for the most part, you just want to pay off your bad debt because that's going to be your greatest return. A lot of people try to get to those thresholds, those numbers. Oh, I'm finally getting $25 a month in dividends. I'm finally getting $100 a month in dividends. Well, a lot of us, we have these crazy credit card balances. And if you can see here, look at this, just on the interest charge on purchases, I was charged $112. I tried to get greedy and tried to get slick the other day, and I did a huge cash advance to myself to get into the options game. That's another $160 that they're charging on that type of interest on that purchase. I threw this additional screenshot down here to show you that I have been responsible family. It is paid off. It's back to zero. So don't think that I'm just running around with 13 G's worth of credit card debt. But I did want people to see that, at its height, you're losing about $275. So you can quickly save $275 every single month, as opposed to trying to build this long-term dividend portfolio, this passive income portfolio. Pay off that credit card debt and you'll instantly be saving hundreds of dollars every month. Stack up an emergency fund, whether it's $500, $1,000, $2,000, whatever works for your lifestyle. What I like to do is I do 3 to 6 month averages, and I go back, I look at my bank statements and I say, hey, what were the one-offs, the unexpected things that pop up? Oh, I had to get my shocks fixed on my car. I had to get, the tires rotated. Oh, the stove went out or the refrigerator went out. Take those unexpected expenses that you had to, pay in the last 3 to 6 months, average them out, and that should be like what your emergency fund is at a minimum, in my opinion. and then keep some play money. And that way, you can still enjoy social events, activities, and all that. I wish I was out there with y'all, because I think a couple of the Black Wall Street fam, some of y'all met up and was able to like meet and greet in person. So, how we are, we like to just get fly or even have a gift for somebody, baby showers, birthdays. So keep that play money, because you don't want to be getting on this journey and you start to have like these like mental stressors of like, dang, I'm doing all this to build this and I'm not really having no fun. So those are like the beginning steps, pardon me, on what I believe you should do before you start. Oh, somebody's waiting to get in, my bad.
Yeah. Quick question on something you just said.
Yeah.
When you're talking about saving and putting away money, you mentioned the one-offs, but something that I was told was that you total up your monthly expenses and then you put it times 3, and some say 6. Is that still the same kind of what you feel as well?
Mine was a little bit more liberal. That general school of thought, I definitely agree with. But at the same time, it could be a little bit discouraging, because getting to like 6 months worth of savings, like people are like, yo, like I want to just get started with this already. You know what I mean? But I definitely agree with that, Mike, for sure. So this one's a little. Yeah, so what I got here, just a little bit, at least you got something, you got your play money, which is a separate pot, and you got your emergency fund, so you're just not completely caught off guard. But if you want to up it and get more solidified, with 3 months worth of expenses or 6 months, whatever the case may be, you can go ahead and handle that. I mean, being fiscally responsible, that's never going to hurt. All right, so you're ready to start dividend investing. You're ready to start getting your passive income going on. And one of the things that, when I've talked to people, the numbers kind of like catch them off guard, and they might think like, man, I got to put all this money in just for that. And so one thing that I want us to keep in mind is always compare it to the base. You can either be at 0, which just means you're not saving anything. You don't even have a savings account, or like most Americans, most people, we have a savings account. And this is what these screenshots show. So here on this left side, and this is crazy because most of us know that, credit unions offer better rates, right? So here's my credit union screenshot, bank balance. This screenshot's from today, sitting at about $7,000. And for credit unions, for those of us that don't know, they consider their account holders like owners. So instead of this being like a quote unquote regular interest payment, they call it a dividend, but it really isn't. It's just interest like on the savings account. So for 7 Gs that I had sitting there for a month, they paid me 11 cents. You multiply that by 12, I'm going to get $1.32. $1.32 for letting my 7G sit there with the credit union. And we know that they're taking that money and running it up. They like Nancy Pelosi, getting the options contracts, investing in everything else, doubling it, tripling it, flipping it. So use that as a base when you think like, yo, if I'm going to give AT&T all this money to get dividends, like, yo, that's barely anything. Just remember, you could have 7G sitting in your savings and you're only going to be getting 11 cents. And that's supposed to be, credit unions are supposed to be the good higher rates. So at a regular traditional bank, it's going to be lower than that.
That's that bullshit.
Exactly. Now, to the other side, and if you keep up with me on social media, you guys see a lot of this. As of today, you see that right there, January 24th. This was earlier today. This is the value of my dividend portfolio at Fidelity, just over $8,300. That is currently yielding me $489.63 a year. So you see, if I wanted to be smarter, I might as well take a big chunk, maybe 5,000-6,000 at least out of here, put it into the stock market, and I'd be way up. I'd probably be closer to getting $1,000 a year now in dividends. So you see, just quickly, your money is working a lot harder and a lot faster, and it's helping to stave off inflation. That's the biggest thing. Like I said, in this global economy with inflation running up, that's what we got going on. And so I just put a little quick video, and you can see these dividends coming in right here.
Boy, got the soundtrack on that. Okay.
I see it.
So just to show you guys, these are all the different companies, and they just come in. They just flowing in every few days. They just coming in nonstop. And so that's the beautiful thing about that passive income. Once you get your portfolio kind of healthy, it gets its weight up. Every time I like to just wake up and boom, somebody's paid me. It just keeps going.
Nice.
All right. So this next slide right here was just mainly for like the young cats. I mean, all of us can use it to apply, but I think about our kids, that are in their like mid-teenage years, just getting their cars, just getting their first jobs. They're being raised by us, the Black Wall Street fam. So they have that fiscal knowledge to want to get into the game, right? But they're thinking like, yo, I don't really have the cash. Like moms and pops, they got the, the mom and pop salary, And so me, I'm just starting out. And these are all things that I do. Everything I'm showing you that I take a lot of pride in, family, this is all things that I have done. These are my screenshots. So these are some simple cash plays that, the kids can use, you can use, or somebody that that might be feeling like their cash is strapped. They can use these plays that I feel like most of us experience, right? The cash back rewards on my credit card, that's $40. I take that and I just put that to the side to buy more dividend paying stock. I sell gift cards. Whenever I get a gift card, I usually just give it up for cash. I'm like, hey, moms, pops, cousins, my homies, who wants this $25 gift card from Target or whatever the case, Best Buy. Let me get the cash for that. And I take that to buy dividend paying stocks. Selling unused items on Poshmark Macari. When I was younger, I was into the designer BS, not to call it BS, to each his own, but before I was smarter financially, fiscally, I was spending most of my money on these designer things like Gucci lanyards and Burberry watches, all that kind of stuff. And you see here, I sold it. Side hustle money. Most of you know that I'm a photographer. I do that. And on the weekends where I don't have a photography gig booked, I'll get up and do Uber Eats for a couple of hours. And you can see that here, Saturday morning, boom, do it for a few hours, take that cash, and I'll be using it to buy more dividend paying stocks. So just to, give people an idea to think outside the box, especially for our younger kids, our young cats out here, they got options,
Could I say something?
Yeah.
That interest on that money in the account was 0.001% that the bank gave them back. 0.001%.
Not even 0.5%. They're not even gonna give me the half of one.
Yeah, not even a third of one. Third of a half of one.
All right, so now we can really get into this. Now we can really get it popping. Dividend. Most of us know.
Could we tell them to put the phones on mute? Everybody can put the phones on mute.
Yeah, family, if you don't mind, just go ahead and hit that mute for us. Of course, if you do have a question, just feel free to jump right in and we can dive in deeper. But like we already know, a dividend is basically a sum of money paid by companies to its shareholders out of its profits or reserves. I call it the easiest form of passive income. It's my favorite. I'm not knocking the other ones. I'm trying to get my weight up like some of my brothers and sisters here, like y'all getting rental properties. But for me, I feel like you can easily just take your phone and in 5 minutes set up a brokerage account, put money into it and start getting dividends within the same month. So that's, to me, it's just like, yo, I can get started with that right away. Okay, now we can really roll up our sleeves and get into some nitty gritty here with these dividends and what they mean and these terms and the key words. So this is a screenshot from the website Seeking Alpha. And just to make sure, am I missing anybody that's trying to get into the room? Is anybody waiting or are we good?
No, I think we all good.
Cool.
I think we're good.
Perfect. Okay, so the number one resource that I use whenever like somebody tells me about a stock that pays dividends, the very first place that I go to is a website called Seeking Alpha. And Seeking Alpha has this dividend scorecard that's just aesthetically pleasing. Everything is just laid out. The numbers and the format is very easy to read. Okay, so what we have here as an example is Bank of America at the close was trading at $31.55. Their dividend yield was 2.27. And basically what your dividend yield is, for those of us that don't know, is without any change, like barring any other variables or factors, if this share price was to stay the same and not move, you should be getting about 2.27% per year on your dividend payments. So I want to kind of bring up a calculator. I should have threw that in here, but if you bring up a calculator, I know Reed is probably on it. If you do 31.55 times 2.27%, it should be getting you that annual payout of about 72 cents, pardon me. So that's what your yield is. Your yield is almost like your return on money. I kind of hesitate to say that because we know the stocks fluctuate, but for the most part, it's kind of like your return on your investment, right? You're going to be getting 2.27% back. So that's your dividend yield. Annual payout, pretty self-explanatory. You're going to be getting 72 cents. Now, here's a very important number right here, is the payout ratio. Now, the payout ratio, you can look at it like this just to keep it simple. The payout ratio, you can look at it based off of $1. For every $1 that Bank of America makes, they have to give back 30 cents of it to their shareholders in dividends. So the higher this number is, the closer this number is to 100, the more of a red flag it's going to be for you. So if you see a company that has an 85%, 90%, 100% payout ratio, they are in kind of danger. And the reason why that's dangerous is because where are you going to get money to expand and open up new stores? Where are you getting money to develop new products? Where are you getting money to get into new technologies? Where are you getting money to expand your market share? So if you see a company with a high payout ratio, you really got to start scratching your head on whether or not you want to invest with them, or if you believe that their business model is going to turn around to be able to still take some funds, whether they get a loan, whether they get, raise money elsewhere to be able to sustain not only the dividend payments. Go ahead, Mike.
So when you say payout ratio of 30%, that means they only have to give back to us 30% of what they brought in.
Right. And let me be a little bit more clear on that. It's not necessarily like they have to, but that's what they are doing based on their numbers.
Right.
Yeah.
Yeah.
So,
So if you throw that at like 90%, like you said, that means everything that they're giving in, they're giving back out.
Exactly. Every dollar they're making, they sending it right back out.
Right.
So if something happens like the pandemic, where you getting the dough to stay afloat?
They don't have no room to play with.
Exactly.
Right.
So that's one of the most important numbers is your payout ratio. Just look at it for every $1, whatever that percentage is, that's what they're paying back out to their shareholders in dividends. Next, we've got the 5-year growth rate. I know a lot of people that I've talked to, they kind of use this as a metric to say, like, do they really have a strong recent history of growing their dividends, So, because of course, the name of the game is not only getting passive income, but it's also having your money grow with inflation. And that's what I was saying earlier, with us being in this global economy, with the way that numbers is raising, like we see it now, it's crazy. Even in my lifetime, and I consider myself to be, relatively young cat at 31 years old, I've seen things where I've been like, yo, this is not, it didn't used to be this expensive not that long ago. 5 years, 10 years ago, whatever this product was, a gallon of milk or whatever the case may be, there's brother Jamal getting back in. It wasn't that expensive. So that's the key here. You'll see that one of the strategies for people is not only dividend paying companies, but companies that have a strong history of increasing their dividends because that income helps you stave off inflation. All right. Now there is, to the payout ratio, let me take a step back. There is a big exception to this rule. There's a big exception to this rule. Of course, dividend growth is the number of years that at least Seeking Alpha has on record for how long they've been growing their dividends. And then these here are a bit more self-explanatory, but we can get into them. So the last announced dividend for Bank of America was announced at 18 cents per share. So for every one that you buy, $31.55, they're going to give you 18 cents. The ex-dividend date is the cutoff date. So at this date of March 4, 2021, the door's closed. You won't be counted for that dividend payment. So you always want to look at the ex-dividend date as the date before. So March 3rd or whatever that business day may be, that might be a Monday. So you might look at Friday's date. So the ex-dividend date, the door's closed, boom, it's too late. Payout date, of course, is when you're actually going to receive your dividends. And then the record date, and this gets a little tricky in certain circumstances, which we'll touch on in a bit later on. But the record date is when the company, Bank of America, was made aware that, yo, you are a true shareholder, right? And then the declaration date or the declared date was when Bank of America told the public that, hey, we went and we looked at all of our numbers, and on March 4th, if you've got your money in or whatever the case may be, we can pay you. So sometimes companies will do it for the entire year. They'll come out and say, hey, we looked at our financials and we can guarantee that every quarter for the entire year of 2021, we'll pay 18 cents to shareholders. Sometimes they just do it for the month, and sometimes they do it quarterly. So here we can kind of see that in January, they've already kind of like went out. And if we were to look at Seeking Alpha, we could take a look. And I'm pretty sure Bank of America might have declared it for just the quarter. And then, of course, the dividend frequency is how often do they pay. You see, there are some that pay monthly, some that pay quarterly, some that pay annually. Some people pay twice a year. Most of the big dogs, the household names like Bank of America, Coca-Cola, McDonald's, so on and so forth, they pay quarterly, but there are some out there that do pay monthly. Speaking of which, here's my favorite company. If you follow me on social media, this company right here has performed the best, but of course that was timing wise for me. This has performed the best in my portfolio. It's a company called LTC Properties, and they are considered a REIT, which is a real estate investment trust. And more specifically, they are a healthcare REIT. So we see that they were trading at $40.09 at the close on the 22nd. They've got a dividend yield of 5.76. So if you were to take out your calculator, put in that math, you should be getting about $2.28 a year return on your investment, if you will, based on that dividend yield. But here's where we get a little gnarly. We've got a payout ratio of 85.01%. It makes you a little like, yo, what are y'all doing with the dough? You know what I mean? Especially if you're a healthcare REIT, you know what I mean? If you're a healthcare industry, you got healthcare properties. If you're giving me 85 cents at every dollar you get, with that other 15 cents, what you gonna really do with it? Now, here's the thing about real estate investment trust, or REITs as they're called. Per the tax law, they have to pay out most of their funds in dividends to their shareholders. So it is not uncommon. You should actually be looking for this number to be at about 85 to 90% in terms of their payout ratio. And this is specifically when you're dealing with REITs, real estate investment trust. And their kickback on the other end is they basically don't have to pay taxes.
I was going to say they must be getting the kickback, because that would make sense.
Exactly.
Okay.
So Uncle Sam was like, yo, you're giving up all the dough, then don't even worry about paying us anything.
Right. Makes
Yep.
sense.
Now you got to ask yourself, though, if you were interested in getting into LTC properties, why is their 5-year growth rate in the negative? You know, why have they had to kick back on this? Now, speaking specifically to this company, only because I'm a little bit familiar with it, what happens with the Medicare, Medicaid game is, because like each year the parameters change, a lot of these healthcare REITs are left in a position where they're constantly having to readjust what they're going to be paying out in dividends. There's pros and cons to everything with that, because got my boy coming in, Julian. Bow. All right. Welcome, brother Julian. But bottom line is, 5-year growth rate is a negative. And this is kind of, I wouldn't say just germane or common with healthcare REITs, but because of changes in administration with Medicare and Medicaid, right? They're constantly having to readjust. And more so because most REITs that you'll find, they pay monthly. So every month they're really looking at numbers like, yo, can we pay this? Can we pay this? If not, do we need to readjust because the Medicare and Medicaid laws have changed? And when they do change, it leaves them with the gap. So you've got like the properties that they have, right? They're healthcare facilities for geriatrics, for the elderly. And the people that are in these skilled nursing facilities, some of them have private pay, and some of them, of course, rely on the Medi-Cal and Medicaid. Now, because the rules change so frequently about how much they're going to cover for their benefits of Medicare or Medicaid, these healthcare REITs are kind of left in a spot where they're like, shoot, the easiest way for us to like maintain financially is just to reduce our dividends, especially since they're paying it out monthly. And then we see here that LTC Properties is paying 19 cents a share. Their ex-dividend date is March 22nd. So you got to be in a business day before. Payout date is the 31st. They declared this in January. So think about that. Here's a monthly REIT. They said in January, we already know what we're going to do in March. You see what I'm saying? Because they pay monthly. And I bet you if we went to the Seeking Alpha website, we would see that in January, they probably looked at the numbers for the next few months, and they did a declaration to the public saying, all right, we got you guys for February, March, April, May. We know for sure we can slide you that 19 cents per share.
Question. So why did you choose this one? Why did you choose LTC Properties? What made it stand out for you to purchase it? With a high payout ratio. I mean, well, you just explained that, but how did you find it? So
there's a cat, and make sure stay on me, family, so I can send out the resources, because that's something else I'm very proud about. But there's this cat named Joseph Carlson on YouTube, and he's a big time dividend growth investor. And he started his portfolio at like 25,000. So I was watching his videos, and when I was learning about dividend income and these companies that kind of specialize, if you will, in paying dividends, he had this in their portfolio. And at that time, the growth rate wasn't changed. They lowered it. And so because they lowered it, the 5-year growth rate dropped a whole lot. And so, with numbers, it gets a little tricky, because what you'll see is this isn't indicative of every year they've reduced it. It's indicative of how much they reduced it, like it affect their averages. Like back in the day, when you would be in school, you'd be doing all your homework assignments, and that 1-0 F's up your whole grade average for that class. You and Mrs. Watson's class, you didn't, got an A+ on the essay, and then you got a C on another assignment, and then on the midterm you got an A. But that one time you missed an entire assignment, you got a 0. It F's up the average. It brings it way down. And that's what happened here. So they brought it down so much that it gave them a negative growth rate like that. And then here we see dividend growth year. So they haven't grown because it, go ahead, Mike.
Oh, yeah. So when you're talking about the dividend, yeah, what is your range of purchase? Like how many do you aim for?
We should be watching.
Like how many shares do I purchase at one time?
No, like, you know, like what's the overall, like, do you have a guide for how many someone should purchase looking to get into dividends? Like you just talking about one stock, 5, 20, like how many do you hold per company, or do you look to hold per company?
So that question for me has grown over time, and I'm going to kind of break it down for you. So when I first started getting into dividend investing, which was in April of last year, right? One of the first things that I had discovered was that there are companies out there that pay monthly. And the reason why that was important for me was, you know, most of us were used to the quarterly, if not like annually, right? But most of the big dogs, they pay quarterly. When I found out that there are companies that pay monthly, I wanted to get on the tangible train. You know, how do I make this tangible for me? Especially like for our kids, right? For the younger cats out there, we want to get our babies in on this 16, 17, 18, 19 years old. They want to see it tangible. And if your timing is off, and you get into Coca-Cola or something like that, you're waiting 3 months to get paid. That could be very like kind of like deflating if you're not patient. And of course, our kids, they want to see it popping. So leading into your question, Mike, where I started with my strategy was I was just accumulating monthly companies, especially when I found out, I realized that these monthly companies, they pay the same week every month. So the first thing I did was I just started collecting monthly companies just to get that tangible feeling, just to be able to wake up, look at my phone and know I got something rolling in. I got to the stage where I had 3 companies that paid in the first week, 3 in the second, 3 in the third, 3 in the fourth, so on and so forth. Now to answer your question directly, there really isn't a minimum threshold. You know, me personally, I would say focus on getting exposure first. Don't focus on accumulating so many in one company. So whether you're trying to get 5 or 10 shares, get what you can at that time. I would say play the dividend payment game. Whatever you can get in that's a sound company that's paying soon, go ahead and get in on them. Then as you get a base for your portfolio, which is where I'm finally at in my own opinion, now I'm going to start focusing heavy, like, can I get 3 shares of this or 5 shares of that? But so to answer your question, that's how it was for me. I didn't really have a threshold starting off. I was just like, let me accumulate, let me get exposed by this. And that's why when you see in that video I played earlier, that's why they're just coming in so frequently. I was just buying what I can. And
so it didn't matter if you just bought one, because for me, I have a number where I target with my dividends. I'm trying to get, you know, at least 50 to 100 of each, because if they're paying you like 18 cents, outside of looking at percentages, you're like, well, there's just 18 cents. So you're trying to make it work for you. You know what I mean?
Exactly. I feel you. So the next stage that I'm working on for me personally, and it's very important that all of us, we set our own personal numbers for what works for you. Mine is now getting whoever I'm invested in, you either need to be paying me $1 minimum, or if not, I need to be looking to get out of that company. Like, why do I really have you? Do I need to, you know, hustle up, get some extra money to buy more shares? So that's my next threshold that motivates me, making sure that each person is at least giving me $1, not the 99 cents or 75 cents. And then from there, once, in my own opinion, once you get that base, you get in that taste where people are paying you frequently, then you can start focusing on the companies that you really like, whether it be AbbVie or whether it be AT&T, so on and so forth. So those are the key words that we want to be familiar with. The most important ones: dividend yield and payout ratio. Of course, you got your frequency and things of that nature. But before I go on, did anybody in any family have any questions about some of these key terms or the Seeking Alpha scorecard?
When you talk about a lot of time in the brokerages, when you purchasing that particular stock for the dividends, they talk about reinvesting dividends. And I reinvest. Can you explain a little bit to the family about instead of taking $1 is to reinvest that money?
Yeah, so I'll touch on it really quickly, but I do have a whole slide for that. So thank you.
Okay. So save it.
As the brother was saying, you know, you can, instead of getting the actual dollar into your account, you know, you can actually have that dividend payment automatically buy more shares. And this is where we get into the compound growth, and it's speeding us up on that road to $1 million. So real quick, they call it DRIP, dividend reinvestment plan. You can turn that feature on with all brokerages, where you get that $1 or that $5 or that $20, whatever they're paying you, it'll automatically buy more shares. Now it's a snowball effect. All right, so I was debating whether or not I wanted to save this toward the end, but I figured let's just get past the boring part, things like that, that we all want to know. This came up in one of our meetings months ago. Do you pay taxes on dividends? Of course, yes. IRS considers it to be income, so yeah, you got to pay taxes. You have to pay taxes when they're automatically reinvested. I think one of our brothers asked that some months ago, because there is a perception or misconception that if I automatically reinvest them, I don't have to pay taxes on them. And Uncle Sam was like, nah, I don't care if you automatically reinvested it. So you made a decision a long time ago that you wanted the money to go back in to buy more shares. You still got income. Break me off. Where's my money at? That's how Uncle Sam looks at it. That's how the IRS looks. So whether or not you automatically reinvest them or not, you're going to pay taxes. But what do the tax rates look like and what do the amounts look like? So this part was a bit tricky for me because there's so many unique variables to us all about our brackets and how much you're going to pay, qualified dividend versus not. So I just found a website that a very, very good article. I've got the link in here too. Like I said earlier, family, stay on me because I want to send you guys all the resources that's included with this presentation, all the links and everything like that. So basically just look at income. So if you got $5,000, made from your job or your side hustle and $30,000 made from dividend income or whatever the case may be, it's all just income. And this is pretty much how this is the single filer, but they have a whole chart for joint filers and everything like that. They even have the 2021 updated amounts. But let's just say we finally get to that stage, right, where I'm not getting money from anything else. My dividend payments are they're taking care of everything for me, right? I got $150,000 a year in dividend income. If you're making 150 G's as a single filer, Uncle Sam wants 24% of that. He was 24%, so you're going to give up 36,000 of that dividend income. So that's just how it goes. The long and short of it, they consider it to be regular income. They're going to tax you at whatever bracket you're in, and that's what you're going to pay. So I think we like to overthink of it, right? Like, oh, well, I made 65,000 at my job, but I made 7,500 from dividends. Well, if you made 65 at your job and 7,500, that puts you at 70 some odd thousand. It's all income. Just find the bracket that you're in, and that's what you're going to pay.
Yeah. Now,
here are some common, ways to kind of protect yourself from the taxes. Your 401k. And the pro to that is you don't pay taxes at the beginning, but of course the con is you pay taxes at the end and you have less investment options with your employer. So for those of us that have like the traditional 9-to-5 and we've got a 401k from our employer, myself included, please roll up your sleeves, get in there and really see what you can invest in. I went gnarly and most of my 401k, 90% of it is buying more shares of the company that I work for.
Great point, bro.
And then next, the Roth IRA. I recently just opened up one of these. I should have did it, but I just did it, recently. The pro is you get no tax gains, no taxes on your gains or your dividends, which I really love. And I'm more the type of person, me personally, that likes to do everything up front. Let me get all my obligations, all of my expenses. Let me just get everything away now, because when it's time for me to ball, I just want to have fun with no restraints. I'm not trying to pay nobody nothing. The cons to that, though, is your money becomes locked up and your post-tax money, right? Because this is money after taxes, it reduces your income. So if we're trying to budget and get on a certain kind of page in terms of like how much we're going to pay for expenses, this is kind of like a new expense you got to incorporate in your monthly budget or weekly budget or whatever you have. So it reduces your play money or the amount of money you have disposable. Your money becomes locked up. It becomes certain parameters that your brokerage and the tax laws will allow you to do when you want to do a withdrawal if something comes up. Other than that, you got to wait until you're 59 and a half before you can start taking from this Roth IRA. But I really do like it because, if you know what you're doing and you're investing in companies that are not only growing, but paying dividends, you ain't got to worry about the taxes at the end of the day. Now, of course, if something happens and you need to take money from that Roth IRA, you're going to have a tax fee, you're going to have a penalty. And so that's the con to it. It becomes locked up in a sense.
Can you tell them what's the penalty?
I don't know off the top of my head. I really don't. A part of it, which is little, it has little to do with your brokerage, but there is a part in terms of how your brokerage operates. But of course, a majority of it is the tax code. I think it's something like a 10% penalty if you're before,
it's 10%. It's 10%.
Yeah, before 59 and a half. Yep.
10%.
All right. So this next slide, I really kind of like because it's the less common ways to avoid these taxes. All right. So one less common way are municipal bonds. And what I like about municipal bonds is you can actually get them as ETFs or shares. So they kind of trade. There are certain companies that will trade on the stock market. So you can buy fractional shares of them. You can buy whole shares. And the reason why I'm making a point to notate that is because if you went and tried to get a real municipal bond, there are certain rules that you have to abide by. Like they want you to buy X amount, like 5,000 minimum. Then it gets locked up with whatever municipality that you're rocking with, right? So you've got to rock with them for a few years until it matures. But the cool thing is they've actually got municipal bond ETFs and stocks that you can buy just on your brokerage app, like you're getting shares of Apple, like you're getting shares of Coca-Cola. And what I really like about this is they're tax proof at the federal level. And these ETFs trade just like stock. But the con to getting into municipal bonds is they have lower rates. So your municipal bonds, and let me take a step back for those of us that don't know, they're basically your way of helping these different cities out and these different states out with building their freeways, their infrastructure. You know, they'll have one like the Wyoming freeway municipal bond, and they're just raising money to pay for this freeway that's being built. And so the yields are a lot lower because a lot of that is kind of tied to like interest rates and the treasury and how the dollar's doing. And so what you'll see with municipal bonds is they're very low compared to just getting a regular dividend paying stock. But like I said, the pro is you don't have to worry about taxes at the federal level. Now, another downside though, and I was trying to find a more straight definitive answer on this, is each state is a little bit different. The general rule of thumb about paying income taxes on municipal bond ETFs for the dividend payments that you receive, the general rule of thumb is if you reside in that state, you don't have to pay state income tax for it. So if you're looking to get into these, you guys can find some that are, you know, Georgia based or Atlanta based, or for me, California/San Diego based. And I'm covered both at the federal and the state level. Now, if you're looking to get into something that is not within your state, you kind of have to roll up your sleeves to see whether or not they're going to charge you state income tax for it. Resources, HYD, I put HYD in bold, pardon me, because this is literally one that I have in my portfolio. And so what we can see here, and this is another thing that's kind of tricky, for whatever reason, I don't know if it's just seeking alpha, they might not have all the current information that you need to have, especially like payout ratio and dividend yield. But before I jump into those, the next kind of thing, and most of us might already know this, is what's called tax loss harvesting. So remember, family, when we're getting ready to do our taxes, if you lost any money on your options trades, on your swings trades, all of that kind of stuff, look at it as a business expense, and you can use those losses as offsets to your gains. I should have dug in more and got you guys more numbers of what that really looks like. Well, like what's the threshold that you could count, but keep that in your mind. Because I know a few of us that got burned, you know, in 2020, especially me with the options trades and the stock trades and getting into swing trading and learning the ropes. So keep that in the back of your mind. If you feel like you'd have made 20, 30 G's doing options trading, go back and look at how much did you lose. And that's going to help you offset your tax exposure. Of course, that resource is going to come from your brokerage. But now we could take a quick look, and I should have included the share prices for these companies. So forgive me, we'll take a look back. But what we can see here for CMU, already they have a low dividend yield, or a decent dividend yield. Their growth rate is negative, which is one of the cons to investing in municipal bonds, because it's kind of like tied to interest rates and the dollar and, you know, what's going on with the economy and things of that nature. You'll see that they have negative growth rates a lot of times, and that their amounts that they're paying per share is very low, 2 cents. And HYD is pretty good, but this is because it's an ETF. So they take municipal bonds from a lot of different municipalities. And, you know, just like ARK, Kathy Wood, their ETF, or whatever, S&P 500 ETFs. And that's why they have a little bit more of a chunky dividend payout. But these two I thought were really interesting. I think that these are little known ways to kind of shield yourself from the taxes. I invested in this HYD only because I wanted some of that peace of mind to know that I'm not bearing the full brunt of all of the dividends that I'm getting paid. You know, I'm protected at the federal level with what I'm getting paid annually from this HYD municipal bond ETF. All right, dividend strategies. So I'm gonna just go over kind of quickly. Please stop me if you guys have any questions. But these are different dividend strategies that we can use. My brother Reed touched on DRIP, dividend reinvestment plan. I call that cruise control. You just set it, turn it on, and you can rock with it. There's special dividends. These are bonus dividends that are paid on performance and profits. So when a company really balls out, they'll do a special dividend on top of whatever their regular one is. Preferred stock, these are hybrid stock. You can kind of think about them in your mind like when the Prius first came out, when it was part gas, part of EV. And, if you've ever been in a vehicle like that, it's kind of weird because it kind of like starts and stutter stops when you're at a stoplight, which is something that I really don't like. But if you've ever been in a hybrid vehicle, you know that. And then there's life insurance. And this is why I put it in gold at the beginning. And then there's options trading and swing trading. So I'll quickly get through those. But of course, stop me if you guys have any questions. All right. Dividend reinvestment plan, AKA cruise control. This is where you have your brokerage automatically reinvest and buy the dividends to buy more shares. Now, there's one thing that I call sports mode. This is just something I kind of coined, right? Sports mode and my strategy when it comes to using drip or dividend reinvestment is this. I don't have it automatically buy shares of the same company. This is a screenshot right here from my Excel sheet that I created of my portfolio. And what we can see on the schedule is I'm forecasted for January to get $27 in dividend payments. Instead of it just going back, and this kind of goes back to what our brother Mike was saying, right? You're talking about just getting 18 cents or whatever the case may be. I take at the end of the month that $27 and I'll just use that to buy more shares of these companies that are lower priced. So here are like the bottom trading companies in my profile, and this is how much they're going for. This was the last price as of the market close. So instead of me worrying about when I'm hustling up using the other methods to get money to buy more dividends paying stocks, once I got to this threshold where here in January, I'm getting $27, here in February, I'm going to be getting 65. I'll just take that 65 bucks and allow that to buy more shares of these. That way I'm not really worried about in my mind, who am I going to buy now? Who am I going to get today? I'll let the dividends take care of the dividends. But that's why I call it sports mode. Instead of the money going right back into AT&T, I'll just take the money that AT&T pays me, right, and buy more shares of maybe Gain or buy more shares of maybe Shaw Communications, whatever the case may be. Then the companies that are more expensive, I let my active money or the money I went and hustled up, I let that money buy more shares of those. So kind of doubling back to your question, Mike, that kind of goes into my strategy, right? Like when I'm determining how many shares I'm going to get or what I'm going to buy, I just let my monthly dividend payment take care of buying more shares of the smaller guys. So I call it like,
you turn off the auto and then just calculate and then move it yourself.
Yes. Okay. Yeah. And that's why I call it sports mode. That's like the sports mode on the car. You getting in there, you just handling it yourself.
Right. Gotcha.
Now there's an app website. Some of us might already be familiar with it. It's called M1 Finance. And M1 Finance is the only app / brokerage that I've found so far that'll allow you to do sports mode on its own. So you can basically tell the system, hey, when I get paid from AT&T, don't buy more shares of AT&T, go get me more shares of Shaw Communications. But from what I've been learning, the way that they work that out, right, with M1 Finance, they have these things called pies. And what you tell the brokerage is, hey, I want 30% of my portfolio to be in gas, energy, and oil. I want 30% to be in telecom and communications. I want 30% to be in like consumer staples. Now, whenever you add money, like you literally put cash in and add it to your portfolio, or whenever you get a dividend payment, M1 Finance will automatically allocate those funds to wherever you're out of balance to keep you at that 30, 30, 30. So it's not as manual as I would like it to be. But if you want to have like the best of both worlds where you're still auto reinvesting, but not necessarily right back on top of that same security, I would recommend downloading M1 Finance. I do believe that this company is going to be one of the dominant players in the next few years because they have what I can consider like intuitive investing. And the whole kind of like platform is more based for dividend investing and growth investing as opposed to like swing trading and options trading and things like that. Kind of like how Robinhood has been known for options trading. I look at M1 Finance as making a name for itself for dividend investors. So check them out. I've got the app. I'm going to start using it more and more, start including it on my social media profile. It's just how it is. But that's one dividend strategy right there. Dividend reinvestment. You can automatically have the shares go back on top of the same security, or you can go into sports mode and use the dividend payments to buy more shares of lower price companies. All right, special dividends. So special dividends, companies will pay these sometimes when they're balling. They didn't look back and said, hey, you know what? We didn't make so much money. We didn't perform so well. If you've been rocking with us, our shareholders, we're going to pay you a special dividend. Now, here's the tricky thing about special dividends. Really, the bottom line is this. if you don't already plan on investing with this company long term, I would say kind of stay away from them. And the reason why is when a company announces a special dividend, and like I said, family, all of this is things that I've experienced myself. When they announce a special dividend, the stock price shoots up, because everybody's running in to get more shares. Like, yo, I want the special dividend. And that's literally what happened with me. So Costco announced a $10 per share special dividend. This is back in November. This article dropped November 17th. When I found out about it, it was a few days later. So I tried to run and I hustled up. I was doing photography gigs. I was doing everything I can to buy shares. So I was buying Costco at a premium because everybody had already bought and was already in on it. The price ran up as we see here. And this is a screenshot from my portfolio in Fidelity. And if you've been following my videos, Costco is the worst performing stock for me in terms of how much money I've lost. So I've just been sitting on this hole waiting for it to come back so I can get out of there. Now, there are some other factors that, contribute to why Costco's doing bad. For those of us that don't know, Warren Buffett sold out completely of his position with Costco. So 1.3 billion, him and Charlie Munger were like, yo, we're done with y'all. We're out. They took the whole 1.3 billion and bounced. So that's another factor as to why Costco's struggling. But I just say exercise caution. The number one thing to keep in mind is if you want to play the special dividend game, it should be a company that you're going to rock with long term because they're going to go up, they're going to go straight right back down, and then they got to climb their way back up to where they normally trade at. Now, here's a tricky thing that I experienced with playing special dividends with another company called Tredegar. In 2020, Tredegar said, yo, if you're rocking with us, we're going to give you $5.95 per share. And they were only trading at $16 a share.
That's great.
They're only trading at $60. They came out and said, yo, we balling. Yo, we did so well. If you rocking with us, we're going to give you $5.95. I put it on TikTok. The video went viral, at least for me. It went viral. It was like 40,000 views on TikTok. People were blowing me up. They're like, yo, I'm getting in. I just bought 100 shares. I just bought this. I just bought that. Here's what I learned the hard way. So not only does the stock spike, and then it drops back down, the SEC says, yo, if a company announces a special dividend that's more than 25% of what the share price is, we're going to move the ex-dividend date to after the payout date. So that F's you up in the game. So what I did was I sold the shares, and I got a message from Fidelity saying like, yo, you sold with pay due bills, meaning that we're going to give your special dividend to somebody else.
Damn. That's a high ass dividend though, man.
Yeah. It was enticing. My eyes got wide. I dropped down on it. I dropped down. I went and bought a gang of shares. I was out there, I'm about to blow up on TikTok too. I'm getting 40,000 views. I'm like, yeah, I'm about to make it.
And then Costco one caught me too. I had dropped it in the group and then I pulled up on the price and I was like, yeah, I'm not spending two and some change for $10 give back. So I just walked away.
Exactly. So bottom line is, in my own opinion, don't play special dividends unless it's already a company that's in your long-term portfolio. And forgive me, I should have included this. There is one that I was able to capitalize on. It's called SLG. And it might have been our sister Tasia. Her and I had a little bit of a commentary on it in the group. I think maybe if she does have kids, or maybe one of the sisters that has kids was thinking about getting it for her kids. And the thing that happened with SLG was they balled out. They said, hey, not only are we going to have a special dividend, we're about to increase our regular dividend. Now, this company was already in my long-term portfolio, but one of the things that SLG did to stave off this catastrophe that I experienced with Costco, they did a reverse split. So they said, okay, we want to keep the value the same because we know how this goes. So they did a reverse split on their shares. So that's another example where it actually worked out in my favor. But it all was because I was already in SLG as a long-term company.
Yeah.
All right, preferred stocks, the hybrid vehicles, right? So these preferred stocks, and this is very interesting to me. I'm going to keep it a buck. I'm going to keep it a buck with your family. This is the only thing I haven't tested. So I would be honored if you guys tested it through me before jumping in. But this is where my research is at so far. Preferred stocks, they operate between like being regular stocks and bonds. So companies will issue these preferred stocks, but they're kind of tied to the treasury. So what you'll see a lot of times are there are companies that have preferred stocks like Bank of America, and their preferred stocks they're astronomical. They're in the 1400s, 1500s. But before I get into my mathematical breakdown of what my thought process is here, we just want to talk about these cautions and considerations. Preferred shares have no voting rights. So for those of us that get those emails, and let's keep it real, how many of us go in and we do the proxy and we go voting on the board of directors and all of that kind of stuff? We're not doing it. But if you get to a stage, right, where you're really heavily invested in the company and you want to play the preferred shares game when it comes to dividends, just remember preferred shares have no voting rights at all. Preferred shares can be postponed from my research and what I've been seeing. So this is why I say, let me test it out. Give me about 3 months, 6 months, family. I can come back with my experience with my results to see if that happens often. But preferred shares can be postponed. So the company has the right to be like, we're going to hold off on paying this dividend to you. Another thing to consider is that preferred shares can be paid in the form of regular shares. So while they announce the cash price, they might say, hey, you know what? Instead of us giving you the cash, we're just going to slide you shares of our regular common stock. Now, another consideration to keep in consideration, pardon me, is that preferred shareholders get paid before regular shareholders. Now, the reason why this is important, this is a shit hits the fan scenario. So if the company is like really struggling financially, if they're having to deal with creditors, they're having to deal with liquidating and things like that, if you have preferred shares, you get claim to your money before regular common shareholders do. So, but the name of the game is to invest in companies that you already going to be long-term with. They're financially sound. Bank of America, companies like that are not going to find themselves in a position to have to worry about liquidating and putting you in a line of sorts to where you're waiting to get your dividends. All right, so now let's get into the numbers, right? Because this is something I stumbled upon these preferred shares and I was like, yo, like, what's this really looking like? So here we got Bank of America trading at $31.55 as of the close. So if I took $31.55, Bank of America is going to give me 18 cents. However, if I took that same $31.55 and bought preferred shares of Bank of America, currently trading at $1,445, they have a dividend payment of $18.13 per preferred share. What does that mean? This basically means your money is going to go longer. You're going to get more bang for your buck. So instead of giving Bank of America $31.55 to get common shares, I can give them $31.55 to get a fraction of a preferred share and get 38 cents. So now I'm up on the game right there. Same thing with another company called AVGO Broadcom. This company, their common shares are already in my portfolio. And for those of us that don't know, Broadcom is one of the biggest kind of like chip manufacturers, processors for Apple. So they have a huge contract with Apple. They do a lot of Apple's business. So regular common shares of Broadcom are going for $4.65 a share, and they've got a regular payout of $3.60. So if you buy one share of Broadcom, they're going to give you $3.60. However, if I took the same amount of money that I was going to get to buy one share, I can buy a preferred share of Broadcom, currently trading at $1,500. They've got a dividend payment per preferred share of $20. So if I took that $4.65, break it down into the fractions and the ratio and the proportion, they're going to give me $6.18, almost twice what I would get for getting a regular common share. And then every now and then you might come across a company that has issued preferred shares that are trading lower than the common share price, but the payment is higher. And this is company Zions Bank Corporation. Zions Bank Corporation common shares are currently at $48.12. You could take that $48.12 and get 34 cents, or you could take that $48.12, buy a preferred share that's only trading at $27.51 with a dividend of 39 cents per share and get 68 cents. So you're going to get twice what you would get getting a common share. So that's something that I found very interesting. But like I said earlier, family, I would like to be the one that tests it out as a guinea pig to get experience. And then you guys look into it and see it as an option if you wanted to play that as a strategy, the preferred shares.
Disclaimer, not a financial advisor, but damn. Not good info, bro. Or
right here. Okay, life insurance. So as many of us probably already know, there are a variety of different types of life insurance. Most of us, we typically would get term life. Term life is like, yo, the company is just going to quickly insure you for 65, 75, 80 years. It's very inexpensive and you're good to go. And that's perfect. And that's cool for our loved ones and our heirs and our kids and these babies. But what I've learned is that one of the way that wealthy people or rich individuals or financially
Yes.
savvy people do it is they get whole life insurance, and more specifically, they get life insurance policies that build cash value. So the cash value builds into the policy over time. The policyholder can take the cash to buy a house, a stock, or business. So I was talking to, and this is my policy, what you see right here. So I have $1 million policy.
You just went over. Bring that back, bro. Please, man.
Okay. Let me slow it down. So whole life insurance. Sometimes they're a different style that also builds cash. It's called universal life insurance. These type of life insurance policies, they're more expensive, but they build cash value. And you can literally take that cash and do whatever you want with it. So over time, you think about it, and this is why I haven't read, use this strategy as a boost only. Like when the cash value gets to the point where it's life-changing, then use it. Don't use it like when it's like this, where you're only going to be getting a couple $1,000s. But what some people do, and I was talking to my life insurance broker, what they'll do is after maybe 20 years, 30 years of the cash value building up, they'll take that and just go buy stock, or they'll take it and buy a business or start a business, or they'll take it and buy a house. That cash value belongs to you while you're alive. So your family gets the death benefit of $1 million or 500,000, whatever you got, but the cash value that's built into it, that's for you. That's for you to kind of reward yourself and do what you want. That's the cash value. So I was talking to my broker, and the broker is saying that a lot of his clients, when the market went down in March because of the pandemic, they took from the cash value and bought shares of stock. So the shares of stock just skyrocketed. Now they sit nice. So now you just got like, you know what I mean? Now you playing with money, you playing crazy. So just imagine this gets to a nice wholesome number, right? Something, you know, like I said, it has to be life changing. Let's just say that this was 50,000, right? You took 50,000 cash value, you bought dividend paying stock. Now you've got this monthly income coming in, you're just chilling. And to kind of paint the picture for you guys, right? This is my $1 million life insurance policy here. I got this policy, I got this policy about 2 years ago. So 2 years ago, it's gone up $2,200 in cash value. So you see that this is a very long-term play. It's a long-term play that where you kind of sitting in your boss, you know, grown woman, grown man, you could be like, you know what? Let me go ahead and make that move. I'll take 70,000 off of the cash value, buy a house or whatever the case may be, or buy some stock or buy a business. I just included it here because you could do it with your dividend paying stock. But the big con and the big caution here, as you guys dig in and you start to learn and you start to research whole life insurance policies, they are very expensive up front, but they're very robust. Not only does this policy build cash, it also pay me disability if something happens at my job. They're gonna just replace my salary. This life insurance policy is gonna pay my salary till I die, which I think is really cool. So whatever I'm making right now, if something happens with me physically and I can't really do the job and my job is on some fuck shit and they're like, yo, we're not paying disability, we're trying to nickel and dime or whatever, the life insurance policy steps up and says, what, Garrick, you were making $100,000 a year or $50,000 a year. We got you for the rest of your life. If you never work, it kicks in. Now, of course, go ahead, Brother Mike.
And just to add on, man, we on the same vibration. I haven't dropped this, but I'm a couple tests away from actually being a broker and having this brokerage life insurance whole life being offered AOD Village. So I put together a team because you're right. What happens is you have a lot of people that's asking me about how do you day trade? And it's funny you bringing this up because everybody can't day trade. They can't sit at the computer and invest. So the company that I'm working with now and getting licensed through to be able to offer insurance, also, they do the same thing. They invest your money. And, you know what I mean? You can take out and say about 20 years, but it also plays the money for you in the different sectors of the market. So you don't have to worry about it. You have your policy that takes care of your family. Yes. And you go, just sending your money every month. So it's dope that you brought this up, man, but I just dropped my news a little early.
No, I'm glad. So we can get more.
Hey, Curtis.
Yeah.
And just to tag on to it, this is also how people become their own bank and they use it as the infinite banking. So you can, like, if you buy a car, you can buy it through this and not pay any interest on it.
That's right. That's right.
Bingo.
I love it. Thank you, sister. Thank you, Mike. And so, Mike, we're gonna be looking. I know I will for sure, but we're gonna be looking for that knowledge and to get the more like intricate details of what this really looks like and how it grows over time and what we can expect to see.
4 more tests, brother. I'm almost done.
Yes.
couple $1 million on my flesh, nigga.
So this is what most of us are familiar with right here. Options trading, swing trading. This is what I call NOS in your car. You know, Fast and the Furious, you hitting that button, you got that NOS tank that opens up. This is NOS, and I learned this from you guys, family. A couple of you said this when I first joined the group back in June. The big plays off the options, we take that income and we buy dividend paying stock. You know, this right here is really powerful because I've seen some of us in here do 5 a day, 10,000 a day, 1,200 or 600, but that's money that a lot of people, the average American, is not making in one day for them job. They're not making it in 1 week from their job. Sometimes based on the wins that we post, they're not making it in 1 month from their job. So it's like NOS to get you like boosted on this journey, road to $1 million, getting your passive income. But what do we already know? FOMO will get you wrecked. I've experienced it. Like I said, I've been doing my mom's options trading as well as mine. She got in on a Tesla play. I had Apple. I sold out of my Apple. By the time I was able to get my funds in Tesla, mine just tanked. She was able to make a G. Apple right after that shot up.
Wow.
Apple right after that shot up. So FOMO will get you wrecked when it comes to options trading, but we know this. We already know it's extremely complex. We already know it's very volatile. And we know that we should only be using money that we're okay with losing it.
Oh, yeah.
So, but
can you tell some of the investors what FOMO stands for?
FOMO stands for fear of missing out. You know, this happened to me a lot of times because we're trying to share with each other. You know, when I posted the iClean screenshot, our brother Reedy posted like DraftKings or whatever the case may be, or all the various options, plays, and contracts and companies that we post. A lot of times, if you, in my own experience, if you're already kind of working on a play, don't have FOMO. If you look at the group and Brother Reed has posted it 3 hours ago, don't have FOMO.
Nayoka stay falling. She used to. Nayoka used to do that.
So don't have FOMO. You have to be, you know, already a step ahead when it comes to options trading, and not necessarily swing trading. You know, swing trading, if you wanted to, you could just hold the security until it comes back up and sell at a later date. Options trading, of course, is time limited and much more fast and much more frequent. But yeah, FOMO will get you wrecked. I've experienced it a few times.
Yeah, all of us have, actually.
Yes. Okay. So this, I believe it. I got you guys right up to the top. All right, motivation. All right. So $1 million in the stock market is a salary and passive income. And that's part of the reason why is road to $1 million. When I started to get into dividend investing, I quickly realized numbers wise, you would need about $1 million to get a salary out of the stock market, right? So what does that look like? Here's my favorite company, LTC. I should have threw music on this. So let's say we took $1 million to buy shares of LTC, right? LTC is currently trading at $40.09. That $1 million is going to get you just under 25,000 shares of LTC. We remember that LTC pays a 19 per share dividend, 19 cents. That's going to get you $4,700 a month because they pay monthly. That equates to $56,872. So $1 million thrown at LTC is going to get you 56,000. But let's say you wanted to kind of apply that to my portfolio, right? What does that look like? Because obviously we're going to be diversified. Obviously we're going to have different companies and things of that nature. So if we took $1 million and we took the current value of my portfolio, $8,331.38, and we divided it, it's 120. That was y'all telling me, that little notification was y'all telling me that I was at the wrong time. 120 times what my portfolio value is, right? I'm getting $489.63 annually. That means if I took $1 million and basically reinvested it the same proportions and the same, types of shares and companies, just threw it on top of itself, right? And I kept the ratios the same, I'd get 58,000. Now, another strategy that I could have included a slide on is a lot of people play dividends for high yields. They just want high yielding companies. AT&T, as we know, has been like the number one, at least for the past year, in terms of a good sound company, or at least one that has a lot of resources that is also high yielding. So if we took that same $1 million and instead of getting LTC, instead of having it diversified, we just wanted to get a high yielder. So you took $1 million divided it by what AT&T is currently trading at, $28.93. It's going to give us just over 34,500 shares. Of course, AT&T is paying 52 cents a share, so that's going to give you just under 18,000 every time they pay. But we know that AT&T pays quarterly; it's a big dog, so that's $71,897. So when we think about $1 million, I kind of keep in my mind that's kind of like where you're going to get to, maybe even like 1.5. But just to keep the number flat and round, $1 million in the stock market is going to get you about a salary.
Crazy.
Now, the next thing that really kind of motivates me is just recently I started to think about life hours and not 9 to 5 hours. Whenever we see something that talks about, Warren Buffett, Jeff Bezos, it's always he would make this every hour. Every hour he makes this, not he makes it between the hours of 9 to 5, like how a lot of us are kind of conditioned to thinking are 9 to 5 hours. And this motivates me because if we take my annual payout where I'm at literally right now, $489.63, divide that by 365. That means on average, every day that I wake up, I'm getting $1.34.
That's impressive, man.
$1.34 every day I wake up. And so we keep hustling, we keep doing all of our plays, whether you got a side hustle, whether you're starting to get really, really good at options trading, this number is going to go up quickly. I did this calculation maybe 2 weeks ago and the number was only at $1.18. So it adds up. It seems very small right now. It seems very small, like, $1.34. That's that, feed the children type of, number right there. Only 10 cents a day, but it adds up because you got to think this is every day nonstop, getting $1.34 in dividends and passive income.
That's compound interest, man.
Yes.
Got a question on that.
Yeah.
So when we talk about trying to work out what we want to make per month, so I have a strategy where I looked at my hourly, like with my job. So for example, say $60 an hour. That's where I got my $500 a day is my goal in the market when I get up. That's my target. And that's what I looked at. Because I hear you say like you need $1 million to replace your salary. And maybe I'm a little confused on that because I'm looking at it like if my salary, if I'm making $60 an hour now, and I look at that per day, per day, that's $480. So if I wake up every day and I hit the market, I'm looking at trying to make $500 a day. And if I can get that down packed, then I replace going to work.
Right.
Would that equate to the same way, or would I be kind of less because of taxes? And you think you can live off of that is what I'm asking? Is that considered day trading in your opinion?
Yes, kind of a couple different questions, but I think overall we're on the same page, Mike. Really, I was thinking in broad terms, if you heard about somebody making 56,000, that's a reasonable salary. Not that that's what we're aiming for, but really just to give you a benchmark of what $1 million looks like. So really, if we really want to talk about, getting into the taxes, we know that depending on how much income you make per year, you're going to get taxed 24%, or it might be 12%, or it might be 50, whatever the case may be, wherever your bracket is. I just wanted to put this out there as a bit of motivation, saying that, hey, this is what you could expect to see once you get to that $1 million mark in your portfolio. Because I have no doubt that us family, all of us are going to be getting to that stage where we have $1 million portfolios. It may happen faster for some or for others, but at this moment in time, 2021, $1 million looks like this in the stock market and dividend payments. But whether or not it suffices for your family and is it, can you live off of that? Now, that's a whole nother thing because let's just say I just got the 71,000 from AT&T. I have to go back and look at my tax bracket to see, okay, if I'm only going to be living off that 71,000, how much does Uncle Sam want off of that? And then of course it gets reduced and things of that nature. But I just wanted to give us an idea of if you woke up tomorrow and you had $1 million dividend portfolio, this is kind of what you could expect to see. So, you can double these numbers and keep the ratio.
You could probably make it though. Because a lot of people, even after taxes on that 71, if you was making that in dividends, say they taxed you at 24%, you still might pull away with a good 40, 50 grand maybe.
But here's the thing as well. We're doing option trading right now. You'll make 5% in a day. Like sometimes we'll be up 5% and don't even want to sell. Right? If you got $1 million, that 5% is 50 bands. You could do that in a day.
Yep.
Exactly. If you look at from the time that we've been trading, all of us together, we average at least 5% a day. You know what I'm saying? And that's how the market is moving. So just
Exactly.
imagine, and to be honest with you, 5% is kind of like a low percentage annually,
Right.
based off of how the stock has been moving the past couple of years, bro. 5% a month is still kind of low.
Mm-hmm.
You move 1% a week. That you moving 5% a week sometimes.
Yep.
You know what I'm saying?
And the
So,
next little motivator in there was time, because I think for those of us that haven't had that experience that our brother Reed was just talking about, options trading, swing trading, seeing those numbers and seeing how powerful and how quick this money is. There's somebody that says, yo, $1 million, that's going to take me forever. It's going to take me forever to get to $1 million just so I can get to, a salary that I could live off of. Like, that, what? And putting forth the effort, right? The discipline. This is what we're all doing. All of us on this call, all of us like mine, which is why we have this group, what I will forever call Black Wall Street, but the Power Circle. Well, we have this group because we're on that same frequency. We realized how powerful this market is. And so I included this screenshot right here. And most of you probably remember on one of our calls months ago where I said it hurt me because I cleared out everything that I have, my savings accounts, all of my stuff to pay off my debt.
remember that. I remember that, bro.
Yes. So I was feeling a certain type of way because I had to start off from zero. So here in April 2020, I started to get into dividend investing and into the market, And what happened was I quickly got to about like $3,500, $4,000. And it hit me. I was like, why the hell do I have a credit card balance? Why do I have a credit card balance if I can, just within a couple of months, I was able to build up a $4,500 or $3,500, $4,000 stock portfolio. So I cleared out everything, paid off my credit card, started off at zero July 1st. Now, July 1st was just 6 months ago. And I will admit to you, family, I wouldn't even look in the mirror and say I've been going super as hard as I could. This is what I would say on a scale from 1 to 10, 10 being like all Madden mode, Nipsey hustle, I'm out here hustling, and 1 being like you're just barely doing nothing. I would say this is what about a 5 looks like. A 5 in terms of effort. July 1st to present day, I was able to get up to 8,300. And I think that's going to be very powerful, especially for our babies, for our younger ones. Like, you could just put forth a little bit of effort and quickly get some racks up under you, like really be doing it. So that's why I say I put time there as a motivator, because time is going to pass by regardless. So just within like 6 months, able to run it back up to twice what I was when I first got in the game.
Yep. I remember that day clearly. You came in.
I remember that.
Didn't know nothing, man. Like, and that's powerful, man. I keep saying that. Yo. That's amazing, and I'm definitely proud of you for that. Yo.
Thank you. And then the last thing is Millie. So this was something that dawned on me just recently, just because of how kind of ironic it was. So for those of us that don't know, I work in the banking industry. I work for a bank. I started off in June. It would be 13 years. So I started off as a, fresh 18, 19-year-old in the banking industry. And there was this lady that would come in, and me and my coworker, Sammy, we sat on the teller line, and she would be like, oh, how old are you guys? And we're like, oh, 18, 19. Sammy was a few years older than me. And she was like, yo, like, you guys should really get into like investing in the stock market and getting dividends. And she'd really be honest, y'all. Like, she would come in each day and she would be like, yo, did y'all start? Did you do it? We're like, nah, not yet. And so then she got a little bit more aggressive. So she started bringing us reading material. And she was just like, yo, like, here's a book on dividend reinvesting. Here's some good companies. She was old school at the time. Mind you, this is 2008, 2009. So it should have still been internet days. But she brought, this is an older lady. She bring in this book and she like, I highlighted the companies I'm investing in and like, do this. And then she come in a couple months later, like, yo, did y'all start yet? And we're like, nah. She's like, you don't understand. You're so young. And I didn't start. I didn't start until I was 40. You need to start right now. And she's like, you guys got to do it. And then we had started. Then she comes in. Sammy's Jewish Mexican. Here I am, Black. This lady comes in one day, and this, at the time, it was very off-putting to me. But when I look back, I would say, yo, she was one of the few ones that cared. She said, yo, you Blacks think that you're poor? And I was like, man. She said, you Blacks think that you're poor in America? She said, when I came over here, I came over on a teacher's salary, having to take care of my parents. And, at the time I was just so off, but I'm like, yo, you have no idea. You're coming over here talking this big stuff, same old narrative that people say Blacks are lazy or this or that. But what I realized, she was pleading with me. She was just trying to say, yo, you're in a very good position to really ball out. She would say like, yo, you don't understand. By the time you get to 30, you're going to be sitting right. And so just to give you a little bit more details about Millie, right? This is to tell you how privileged I was, because it wasn't like she was gassing me up. I was her banker. I could see her bank account. So it wasn't like she's just throwing stuff at me, making it up. This woman back then at 2008 was getting $30,000 a quarter from ExxonMobil in dividend payments. Whenever a niece or nephew of hers would get married, she'd automatically buy them a house. So she'd come into the bank and be like, yo, I need a cashier's check for $565,000, some odd cents made payable to this escrow company. I was like, oh, did Linda just get married? She's like, yeah, Linda's finally getting married. Oh, did your nephew Andrew get married? Yeah, Andrew's getting married. That's where she was at with the dividend game and where she was getting passive, like,
That's
yo.
crazy.
But here's the thing. Here's the kicker. This is why I'm telling you guys this on this story called Road to a Million. And one of my motivators, that lady's name was Mildred, and we called her Millie. And so it's just so crazy that it comes back to me full circle that I'm on this road to a million. And I think about her because what's up, Millie? We come in and say, wait, what's going on? This old lady kind of like rigging, like walking in all fragile. And I think about it now, especially Reed. I think it was you that made me realize this, how it came back, because you posted on your story, Road to a Millie. And it didn't click in my head because I've been saying the full Road to a Million. And that first time you said Road to a Million, I was like, damn, I remember Millie. I remember Millie used to come in there and she would beg me and Sammy to get started right away. And so that is something that sticks in my mind and why I really want our young people to start now. And I ask God all the time, I'm like, yo, tell me the words I need to say to them to make it click. Because I wasn't hearing Millie at all. So that's why I want the young ones to start now. Because just imagine if you could be 16, 17 starting this, by the time you're my age, 30, who knows? What?
That's why it's very important we break these cycles. I think, you know what I mean, it's good that we have kids around us that we are teaching. I'm very proud that my son was able to jump in and like I showed, you know, he purchased his own vehicle, you know, playing this game.
Yep.
I mean, so instead of waiting until we get to 40, 50 to start saying, all right, let me think about this and start investing, imagine where they would be. They'd be in better position to not only take care of themselves, but in case if we didn't get shit together, they'd be in position to handle that as well. So yeah, this is dope, man.
I just had my son sitting with me. I told him I just wanted him to listen. He was just looking at me like, I don't understand. What he's talking about. I'm just kind of like, I just want you to familiarize with the terms, like small things.
And that's what I be telling to the older Black folks about crypto. You know, I say, I don't necessarily want you to just jump in and start buying now, but I want you to start getting used to having these conversations and hearing the terms. Because I talk to some, you know, the older folks in my village, and they're like, so if I have one Bitcoin, you know, what is that? What can I do with that? And what's a wallet? So I'm trying to make it commonplace because Reed, you said it perfectly. When you're just familiar with the terms, then when you get into the game, you have this level of confidence and familiarity so you can move and groove better, at least in my opinion. You know, I do believe there's going to come a day where, you know, cryptocurrency, digital currency is going to be our standard. And if we don't even know what terms go with it, you know, our people are going to get taken advantage of.
Yep.
So, but yo,
you killed it, bro. You bodied that, man. For real, man. You killed that, bro. Like, it's so inspiring, man, to hear everybody.
Yeah.
Just to be able to see the facilitation and just like the visuals, it changes the game. Flocka had put his portfolio up a couple of months ago. He had about $3 million in his portfolio, and he talked about, I think he made like 3%, and it was like a $90,000 a day. And he just was like, "Yo, it's just 3%." And this was a while ago. He was like, "Yo, it's just 3%." And obviously, you know, people don't have that type of money, but just to kind of like see that shit is like snowball. Crazy.
Yep. But yeah, so
crazy,
thank you, family. Like I said before, like I'm just super honored to be able to present that. My experiences so far, you know, the live screenshots, the recent screenshots, to break it all down. You know, I feel like most of that stuff, most of us kind of already kind of handle on and knew, but to see it kind of laid out, I definitely was happy to do that, to show. But yeah. If there's any questions that, you know, I want the family to ask, and if we have any specific questions about my experience with the dividends or, you know, anything like that, please ask. Let's dive into it. I know that we've been on for a minute, so I also don't want people to be like, yo.
I mean, you touched on everything, man. Yeah, that was good. Even the credit card thing, I've been doing that over the last couple months already. using that money. And I thought about it like a few months ago, like how you just said, like, why am I making this money and still have debt?
Yes.
So I'll pull and just pull and pay, and then just get back in and play and make it back up. So
Right.
Yeah.
And then you spend less when you do that too, Mike. You know
Yeah.
what I'm saying? Like you'll have a certain, let's say you have $100, right? But
Mhm.
you pay $80 off of it. Now you're a little bit more frugal because you got 20 left, but you already used that 80 to do something good. So that
Exactly.
should make sense, bro.
Yeah.
Or appreciate you, bro. Anybody questions for the bro? Yo,
Hey man, I just appreciate the knowledge, good brother. I'll be looking forward to that recording. I was texting Reed. I was like, I'm gonna need that full recording, dog.
I got y'all, family.
I need that full recording. That was a lot, but it was great information, man. I appreciate you.
Hell yeah.
word. I think that's pretty much it, y'all. Send that link too with the group for those who didn't get a chance to get on, man. But you killed it, bro, for real. No shit.
For sure. All right, I'll get that recording out. More than likely, probably because of the size, I have to send it like a Google Drive link, right? Because we haven't sent the recording out yet, right?
Mm-hmm.
Yeah. So I'll get everybody's emails and then send it as a Google Drive, and everybody have access just to download it.
Okay. And if you can send it to me too, I want to put it in the Village and Teams as another video. All the videos I load up there as well.
Okay.
Just in case anybody ever sign on and want to use them, they'll be there too.
Yes.
All
All right, family. Y'all have a good night.
right, y'all. Peace.
All right, peace.
Peace.
Peace.